I didn't knew where the money is actually, in US.
Yes.
So maybe,
Yes.
and I just walked around the floor and
Yeah.
I was like asking people, you know where the monies came from? Nobody
No,
knew.
you're right. So in other words, for an investor, the punchline, so to speak, is go to where the money is, right? Not manufacturing, not so much to brands. We want to go to tech, which is where all the value or most of the value in the economy is being created.
They knew where the money is now.
Then they are where the money is now, yes.
Isn't it too expensive? I
Yeah.
think it's too late to come in,
Yeah.
something like that, especially the high PEs.
Well, remember, noise and signal. And it's a good investor's job, any good business person's job, really any good human being's job, to distinguish between noise and signal. You could say this in politics too, right? A politician says 100 things, but only 5 things of what he says is matter. Most of it is blah, blah, blah. Same with a business. I get this question a lot. Oh, it's too expensive. Oh, it's too late. Okay, that's a statement, but let's look at the reality. I use Amazon as an example. So Amazon in the States has a 40% market share, 40% market share of e-commerce. E-commerce itself in the United States has a 15% market share.
15?
1-5.
Only 15?
Only
I thought it would
15.
be much higher.
Korea is, I think, is closer to 30, 25,
Yeah,
30%.
yeah.
Because you started later. Your economy has grown at a later pace, so there was less habits formed for brick and mortar retail shopping. So 15% of our sales, in other words, 1 out of every $7 is spent online in the United States. And Amazon has 40% of that. So that means that they have 6%. So is that a big number?
No, I don't think so.
Where do you think that will be in 10 years?
Maybe 20, 30?
Who knows? But 100% it will be higher, right? Inevitable it will be higher, inevitably, because it's easy, it's cheap, it's convenient, right? Amazon makes it easier and easier to get stuff every day. And I'm sure the same thing is happening with Coupang. So when people say, oh, it's too late, and then I tell them that Amazon has 6% retail sales in the US, one's a statement and one's a fact. One is noise and one is signal. People say, oh, it's too expensive, too expensive. Amazon's a little tricky because you have to make some adjustments to their financial statements. But Google, you don't have to make adjustments to financial statements. So Google is trading on a PE basis for the same price as the average company in America. So you say to yourself, well, here I have an incredible business that has 90% plus market share of search, that has withstood all sorts of competition, right? Last year, Microsoft said, ChatGPT, try Bing, ChatGPT is going to change the world. Microsoft's share of search since then has gone down. So noise, signal. So you have this incredible business that has 90% share of search, that has all these other businesses like Android, Waymo, YouTube, which we are on right now, and it's selling as if it were an average company. Is Google an average company?
No, definitely
Google is a
not.
far superior company. It should trade at a much higher multiple. So when I hear this, too expensive, too late, I get a little annoyed. That's blah, blah, blah. And what I'm telling you are facts, are realities. But then I say to myself, well, that's an investor's job, is to distinguish between noise and signal.
Signals, yes.
Rhetoric and fact.
I think that mostly answered my question. I was about to ask you this question. So like the so forth M7 or FANG or blah, 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 just few tech stocks, they are leading, they're like dominating and leading all this market share. But so I was about to ask you, do you think like we are in a new IT bubble, or do you think this is like a birth of new tech era? But then
I would say it's more the second. We're in the early stages, we would say in America, and I know Koreans understand it because like Americans, you love baseball. We're in the early innings of a tech era. Mainly, people think that it's too late or that it's a bubble because the value of these companies has gotten so big so fast. But as I was just telling you, these companies are neither mature, they still have a lot of growth, and nor are they particularly expensive. companies like Apple, Amazon, Microsoft, Google, they're going to be able to capitalize on whatever new trend comes along. So right now, AI is the hot new thing. Because if you remember, 5 years ago, it was virtual reality. That was the thing. And it's not so good. You know, and then it was driverless cars. Driverless cars is coming. Well, it's going to be later, right? My point is that it doesn't matter whether it's driverless cars or quantum computing or AI, all these trends are coming and they're all going to happen sooner or later. So who's going to prosper? Big tech, because only big tech has the scale to monetize and commercialize these technologies. I mean, it's no accident that Sam Altman sold a big share of OpenAI to Microsoft. Why did he sell? Because he needed capital. He needed resources. Only a few companies in the world can provide those resources.
So, I mean, we talked about PEs like just before. So, can you elaborate a little bit more? Because I know that you have a different lens when you look into the PEs of tech stocks.
Yes. I like using something that I call earnings power. The financial statements say one thing. And Amazon is a good example. They're required by law to prepare their financial statements a certain way in accordance with accounting principles. But because they're so ambitious, they're spending a lot of money that a company like Coca-Cola or Exxon wouldn't spend, precisely because there's so much growth in the future, number one. Number two, the accounting laws penalize tech companies. Well, the accounting rules were created in the manufacturing era. So they were created to understand and describe the reality of the factory era. So this is getting a little technical, but if you're an industrial company and you build a factory, and let's say the factory costs $100 million, you are allowed to recognize the costs of that $100 million over, say, 20 years. So every year you expense $5 million. But if I'm a tech company and I spend $100 million in research and development, which is in essence my factory, right? Because I don't have any factories. My factories are my people creating new applications and code. I'm required to expense every dollar of that $100 million through the financial statements. So an industrial company has $5 of expense, $5 million of expense, whereas a tech company has $100 million of recognized expense. So their profits are depressed by this accounting convention. Now, it's important to understand that these rules, when they were made, they made sense because research and development used to be very speculative, right? We were two scientists in a lab. We're going to do some experiments. We're going to write some code. We're going to try to build a semiconductor chip. Maybe it'll work, maybe it won't. So we have to write off that expense immediately. Whereas a factory, we knew it was going to work, right? Or likely to work. So we could write it off over time because it had a useful life of 20 years. Well, today though, every dollar of expense that Amazon makes to improve its website must be expensed right away, as if it doesn't have a useful life. Every dollar that Google spends to improve its search engine must be written off right away. Whereas the truth is, Google and Amazon and Microsoft and Apple are all, every dollar of money they're spending on their core business is expanding their heja, right? So of course it has a useful life of greater than 1 year. So in the book, I go through, and it's a little technical, but basically in the book I say, look, Amazon's reported profits are not what their real profits are. Number one, they're spending so much because they're so ambitious. And number two, the accounting rules penalize them that their profits are way depressed compared to what I call their earnings power, their ability to generate free cash flow. Here again, if people are really interested, they ought to read the book and they'll understand. But the punchline is, I think that Amazon's earnings power is understated by a factor of 7. So if the financial statements say they're earning $1, they're really earning $7.
Wow, really? That much?
Yeah, that much. So if the PE is 100, let's say,
and the adjusted
is 100 divided by 7.
Didn't you?
Right.
So it's not overvalued after all, maybe.
Correct. Which is why it keeps going up.
How about like other companies like Google or Microsoft? Do you have any?
They all have these certain wrinkles. I mean, I prefer Google and Amazon because they're much more ambitious in their spending for the future. A company like Microsoft, they'll show much higher profitability today because they don't spend so much for tomorrow. Apple also is much less ambitious. So they're more mature companies, in my opinion. I mean, they're great companies and they have good futures, but they don't have the disconnect in their earnings power. So really what you see as their price to earnings is much more representative reality. They're not distorted. And I like distortions.
So Adam, that was a very fascinating discussions that we had. So Adam, before we close up, I'd like to share very exciting news. We actually are launching 4 new tech value chain ETF, which is Microsoft, Google, NVIDIA, and Apple value chain active ETF. So these ETF actually will allocate around 25% of its assets to the respective leading tech companies mentioned in their name and the other surrounding value chain companies that could benefit from the growth, industry growth. So what's your initial thought about this, maybe?
Well, I can't endorse any specific product.
I know.
My lawyers would not be happy with me.
Will kill you.
Would kill me, yes. But that said, I generally, as you know from my book, I think that tech is where the money is. So any investment that is geared toward tech, and especially the big tech, I think has a good future.
I mean, thank you, Adam. It has been a very enlightening conversation again. And I think we could all agree that investing in digital age requires a very new mindset. Embracing change and maybe understanding unique value proposition of tech companies can open up a significant opportunity. So any final thoughts you would like to share with the audience?
Well, thank you so much for having me. I really enjoyed my time in Korea. I would just say to investors, not to get carried away, as I said earlier, by the flashing lights and the ups and the downs. That's always going to happen, even in a good investment. You know, I think Apple has gone down 30%, 3 or 4 times in the last 15 years. So you have to be prepared for volatility, and you have to learn to be even when the volatility comes. And in fact, if you get really good at that, you can use volatility to your advantage. So if a stock you like goes down, of course you're going to initially feel anxious, but then you need to get beyond that feeling of anxiety and you need to go through your checklist, right?
The B, M, and P.
The stock is down, but is the business any different? If the answer is no, then you say, good. Is the management different? If the answer is no, then you're okay. Is the price different? Yes. The price is better.
It's on sale.
It's on sale. People are great at shopping for dishwashers and cars, and when they go to the grocery store, they know how to. They know when something good is on sale. But when it comes to the stock market,
Panic.
they panic. People should understand, and this is the most important point. The stock market is just a market. It's like a grocery store. So just as when you go into a grocery store, you take advantage of lower prices for good merchandise, so too should you take advantage of good merchandise that goes on sale in the stock market.
As long as it has good business and
That's
good
right.
management.
That's why the template is so helpful, because all you have to do is go through your checklist. Is the business still good? Is the management still good? If that's the case, then the price has improved, right? The price is not noise, it's not signal, it's noise.
Thank you very much, and I hope you have a nice Korea visit after this interview.
감사합니다.
Yes. 감사합니다.